Hei alle sammen. Velkommen til dette webinaret fra Daytrader.no og Daytrader.dk. Jeg heter Torjus Svensson, jeg jobber i Daytrader.no. Og i dag er vi så heldige å ha med oss John Hardy fra Saxo Bank. Han jobber daglig med å utvikle strategier og lage analyser av valutamarkedet for Saxo Bank. Og han har faktisk vunnet mange priser for sitt arbeid. I 2015 så ble John Hardy valgt som den mest presise analytikeren i forhold til det å forutsi valutamarkedet over en periode på 12 måneder. Han ble også ofte brukt som kommentator på CNBC og på Bloomberg. Jeg har ikke så veldig mye mer å si i forkant her nå, så hvis du er med oss, John.
I am. Hello.
Perfect. And the webinar will be held in English. Just write questions to me in English or Danish or Norwegian, and I will try to bring them forward to John. Okay, John, I'll give you the screen. Here we are.
So I hope you can see it there. Is that good?
Yeah. Looks
great. Okay, I suppose I'll get started then. Thanks for inviting me, and thank you for attending, everyone. Very little bit about myself. John Hardy, head of FX strategy. Sorry for holding this in English. I could probably get through it in Danish, but I'm used to speaking financial markets in English, even though I could probably fix up a house and do gardening better in Danish, having lived in Denmark for most of the last 20 years. But do bear with me. If you have a strong comment that I'm speaking too quickly and you're not following along, if several people are having that problem, I am known for speaking somewhat quickly, even to native speakers. So do flag that to the host, and he can pass that along to me. I've been in the FX markets most of the last 15 years. I've been head of FX strategy for most of the last 13 years at Saxo Bank. And today, the purpose of this presentation really is, I'm assuming that you all have a strong interest in trading and maybe some experience trading, but maybe not Forex so much. And what I'd like to do with this presentation today is to point out what's interesting about the Forex market, what's unique, and essentially how it differs from other markets, and give you a flavor for what drives Forex and how that changes over time, because the drivers do shift. What the market is focusing on is constantly shifting, as I hope you'll see over the course of this presentation. And as well, I'll give you some insight into maybe a few indicators that you might find interesting, especially the more sophisticated variety if you really want to delve deeper into this, and a little bit just at the tail end on how I look at charts and maybe what I'm seeing right now in some of the major FX pairs. Brief disclaimer: anything I'm saying today should not be I should not be accountable for any trading risk on your part, and any directional comments I make on the market should be seen as my thoughts on where the market is headed, and not as any kind of direct trade recommendation. Okay, a real brief overview. Global foreign exchange market. What is it? Well, it's an extremely liquid market. Trillions of dollars being traded every day in the major currencies, especially. That's where the vast majority of the volume is, and I'll get to those currencies in a moment. And what's unique and different about FX, I think, and the mentality of trading FX, which is quite novel or different from other asset classes, is that you're trading a relationship. You're not going up or down on one thing, but you're going up or down on one thing versus another thing. So you're always buying something, but also selling something else at the same time. Of course, it's an exchange rate, so that's the nature of the transaction. What are the advantages of trading FX, if any? Well, it's in a very liquid market. It trades around the clock during the week, at least. 24-hour liquidity for at least for the most major pairs. If you want to trade South African Rand in the Asian hours, good luck with that. But for euro versus the dollar versus the yen and the other major currencies, it's very liquid and easy to get in and out of positions. You tend to have less of a gap risk than, of course, equities, where you're seeing sometimes, of course, earnings reports out before opening, and suddenly the thing gaps 20%, etc. Of course, if you have leverage, a lot of leverage in the Forex market, you can risk these gaps, and sometimes there is a earthquake over the weekend, if you will, for example, like we had with the French election or something like that, which can cause gaps. But most of the time, there's less gap risk. It's very transparent. It's very easy to get pricing data that's up to the second without having to pay any kind of exchange fees, because it's an over-the-counter market, and it's all that pricing information is freely available. Some would say, and I'm among these, that it's very technical often, especially for the most major, very highly traded pairs, very technical in the way it behaves in terms of price action, and some people like that aspect of it. And for the more advanced traders that like to deal with, especially with limiting your risk and going long volatility, you can. There's a very highly developed options market and very liquid options market with a lot of flexibility. You can pick any strike price, any expiration date, and trade options based on that. Whereas, of course, exchange traded options are limited in terms of the variety of expiration dates or expiry dates and so on. Disadvantages, and there are disadvantages to trading FX, I think, especially around understanding how it's different and where you can get into trouble. I think there's there tends to be a lack of understanding of, in general, especially in newer traders, on the risks from trading leverage. And FX does allow a lot of leverage because it is so liquid and because it doesn't move a high percentage amount day to day. Leverage is available for those that like to use the leverage and take higher risks. But that brings with it a lot of risk of drawdowns, and I'll talk about that in a second as well. There are a number of fundamental inputs, and these can be, I think, confusing for the trader to follow. And it can be a constantly shifting set of fundamentals that people are looking at. So, right now, for example, U.S. trade deficit data, nobody cares. Back when I was starting, the monthly trade deficit data of the U.S. Was tremendously influential on any given day when it was released. So there are fundamental inputs, but you have to kind of follow what the market theme is, and you have to follow, how much the market is already positioned for something to happen. What are the expectations, and what is that fundamental data relative to those expectations? Of course, that's the case for most other assets as well. And the other thing about FX that I think is a disadvantage, especially, let's say, for people used to managing more passive, let's say, bond and equity portfolios, stock portfolios, that it's not really, most of the times at least, it's not a passive asset class. You're not just buying FX and looking for a solid, steady return. It's a trader's market. It goes up and down, back and forth. There are times when you have big trends that are worth following. There are ways to participate in these so-called carry trades that I'll get to in a while. But in general, it's not, it's not something you just buy and hold for the most part. And this slide here is meant sort of as a warning for folks, just to understand the risks from leverage and how it feeds into the kind of returns you need to develop if you're going to be employing massive leverage. For my example here, I use dollar versus the yen, which you can get less than 2 pips, but I'm just using 2 pips as the example. You can get less than 2 pips on your spread, or on your effective spread if you take a very small spread plus a very small commission. The effective spread can be effectively less than 2 pips, almost half that in fact, but that doesn't matter. The point is just the maths of leverage. So at 1 times leverage, as in my first example here, a 2 pip spread, let's say dollar yen is trading at 100. It's trading at 110, but just for argument's sake, it has traded at 100 before. And if you are trading at 2 pips at 1 times leverage, that effectively means your cost for trading is about 0.02%. Let's say you trade once a day for 250 days. To beat the market, to have an edge, to make up that 0.02%, you need a return of about 5% just to break even at the end of the year. Example 2, and 50 times leverage is available in the Forex market. I would never, ever recommend that anybody trade with this kind of leverage. The reason it's available is that, unfortunately, very many clients demand this. There are occasions where it's possible, especially if you have very deep pockets and you simply just don't want to have a lot of capital in your trading account and you're willing to top up that account like a on a regular basis, whatever. That effectively, that 2 pips, when it 50 times, bring it to 50 times leverage is effectively a 1% trading cost. It doesn't sound terrible, but it means, of course, you buy, sell immediately, you're down 1% right off the bat. Do that for 250 days straight. Your required return to break even is about 1,200%. Okay, so that gives you an idea of the risks involved when you leverage things up. And of course, the basic law of drawdowns. Look, you lose 10%, it's not devastating because it only requires 11.1% to get back to break even. Lose 20, even, not that bad. It requires only 25% return to get back. But then it gets really ugly when you're allowing yourself to draw your account down significantly. Lose 50% requires 100%. Lose 75% requires 400%. It's just to make you aware of the risks of leverage. Okay, let's get on to the fun stuff, and that includes what is it that drives FX? What are people focusing on when they trade FX, and what motivates them to buy one currency against another? And all these are related. They're not neatly sorted into categories, and some of them are the same thing, but from different angles. First and foremost, especially in the age since the global financial crisis and the importance of central bank policy is, of course, that policy itself. Is the central bank about to hike rates? Is it about to cut rates? Is it about to do a massive quantitative easing program? Is it about to end that program? That's been the prime mover of markets almost exclusively in a lot of ways since the global financial crisis in particular, and that continues. And then when things are really quiet and we're not expecting a lot from central banks, for the near future, we can start focusing on other bits and pieces. But central banks are very important. And of course, that's part of what they're doing is fiddling with the interest rate. And with the interest rate, it's not just the policy rate itself. Is the Norwegian deposit rate 0.5%, or is it going to be 0.75% the next time around? But it's also the real interest rates. So you can have interest rate policy, but if one area has high inflation and a low interest rate, that's very negative for the currency because it means the real interest rate is very low. So that's what I mean by real rates here. So are you getting a return that compensates you for the inflation? And Norway, for example, the Norwegian krone has had very poor real rates, and it's one of the reasons it's as weak as it is. Some of the emerging markets, Russian ruble, for example, has a policy rate over 9%, but inflation is under 5%. So you're getting a real rate of a spectacular 4+% versus a negative, let's say, 1.5 to 2%, and it's been even worse in Norway. Economic data, of course, that's going to affect your inflation. It's going to affect whether the central bank thinks the economy is overheating, et cetera, et cetera. So the key data releases that alter impressions of where the economy is going and where the central bank is going to set policy is very important. Tomorrow, for example, we have the U.S. jobs report, including the change in non-farm payrolls. If we saw a strong number for the one of the alternative surveys for payrolls called the ADP today, it was very strong. Saw the dollar picking up a bit there. If tomorrow's number is also very strong, that's important, but also very important, and something that's become more important, again, the focus shifts from month to month and year to year, is the average hourly earnings, because that's what's seen as key for driving inflation that will have the United States Federal Reserve, the central bank of the U.S., hiking rates more or less relative to what's currently expected. Other things that can move currencies are current account. By that, I mean trade deficits or trade surpluses. If you're running constant deficits, it's negative for your currency. It requires money to be flowing into your country to offset that. And if money's not flowing in, then that's going to be, your currency is going to weaken. If your capital flows are not offsetting the trade deficits and your other deficits, your current account deficit. An example of that is the Brexit risk. So the UK runs a huge current account deficit, massive trade deficit and budget deficit. It requires constant inflows into the United Kingdom to offset those. Well, when the UK says we're going to leave the EU, people start to worry about putting their money in the UK, and then of course those capital flows risk reversing, and the pound sterling weakens very strongly. There can be other examples of effects on capital flows. It could be policy. And that's what I've put here at the bottom. So the big focus this year, for example, has been on U.S. tax policy, which was expected to change under Donald Trump when he was elected. That's why the dollar jumped so much. When he was elected, they got over their worries about him being a chaotic personality and thought about what chance the Republicans might have to cut taxes and see U.S. corporations sending massive money back home, etc. That would have been very positive for the dollar. But now we're sort of hung up on whether that's going to happen or not, and that's one of the reasons the dollar has been weakening. Okay. So when we're talking about currency, sometimes you'll hear the G's used, and these G's are not the same as the G7, the political G7, or the political G20. It could be a bit confusing. Sometimes you'll hear G3. G3 is simply the three most traded currencies: the dollar, the euro, the yen. Occasionally you'll hear G5, not so much, but G7 is pretty common. It has nothing to do with the political G7. It has to do with the 7 most traded currencies. Historically, the G10, which are very often referred to, this is a very common description, includes the G7 currencies plus the Kiwi, the New Zealand dollar, that is, the Swedish krona, and the Norwegian krona. Now, actually, especially these last two have become much smaller relative to some of the bigger emerging market currencies, but still you see G10 to describe all of these. And then you have your bigger emerging market currencies, the Chinese yuan, and we can't trade that because of capital controls, but we can trade the offshore version of it, the offshore Chinese yuan, the CNH, Mexican peso, Russian ruble, Turkish lira, etc. And then we have currencies that are a little bit less tradable that I won't mention much about, but these are only tradable by bigger market participants. But it has to do with something called the forward market. So some examples of and I've got a bunch of examples. This is just to give you, again, a flavor for what is driving currency. So of course, for the Norwegian krona, some of you are from Norway. I think some of you are also from Denmark, but for all intents and purposes, at many points in time, at least, the Norwegian krona is more or less a petrocurrency because of the obvious size of the oil industry and driving economic growth in Norway. And when oil is $100 a barrel, despite the petroleum fund or the government pension fund or whatever it's called now, tons of oil activity and high prices is going to heat up the Norwegian economy. It will heat up the central bank's desire to raise rates, etc. So you'll see at points in time the Norwegian krona going up, which I have here in white. That's the trade-weighted Norwegian krona. So it's gone up very high here, and you can see the oil is in orange here at very high levels, near $110 a barrel for Brent crude oil. Now, there are various reasons why it's moved maybe up a bit more here and a bit down here. That has to do with the euro, especially being very weak here and then being a lot stronger here. That's the largest trading partner for Norway. But clearly, once that euro situation got sorted out and oil prices started collapsing, you saw a very tight correlation since essentially the last half of 2014 between the trade-weighted Norwegian krona and crude oil. So at times, how can you use this? Well, at times you see, again, here we have the Norwegian krona. I'm assuming you can see my mouse cursor, okay? You'll see the Norwegian krona up quite high. In local terms, it's launched a pretty good rally here, and yet oil's not doing much. And indeed, it kind of goes sideways for a while. Looked like it was a bit overextended. So, you can use one of these, an indicator like this as a relative pricing thing, especially in the bigger picture when it looks like one thing is maybe moving too far out of whack relative to an important fundamental indicator. Here's the Norwegian krona versus the Swedish krona and how it's done relative to interest rates. The difference in interest rates, which I've shown here in white. So that's if you take the 2-year, which is interesting because the 2-year interest rate includes essentially how much the central bank is expected to do in terms of moving the interest rate policy over the next couple of years. So it includes a bit of expectations, not just what the deposit rate is now, but what it is going to be over the next couple of years. So that spread, or that interest rate spread, I've shown in white here. So currently, with the negative rates policy in Sweden, it's quite large at 1.43%. And you can see, again, the correlation is not perfect, but the directional move is very much correlated as the Norway's relative rate goes up. generally so does the Norwegian krona relative to the Swedish krona. Now, one reason that the Norwegian krona did fall again here was due to the impact of the oil drop. But directionally, you can see how much interest rate moves impact a currency's direction. Other times, especially in very heated equity markets, and this was the case for the US dollar back in the big internet bubble days, everybody wanted to participate in those huge US internet bubble stocks, and Sweden had one as well in the form of Ericsson. So it got to be so large, on the order of $200 billion, which is extremely large. It's 40% of Swedish GDP in one stock. So you can see there's probably a correlation here between foreign buyers, sending money into Sweden to scoop up Ericsson stock, and then when that stock collapsed, you saw the Swedish krona dropping versus the euro, which is shown in yellow here. Sorry, I keep flipping forward instead of when I click, I'm thinking I'm going to show something. So in green you have the Ericsson stock price, and then in yellow the Swedish krona versus the euro. And this chart here, I'm simply showing how much influence any individual ECB meeting, how it sets the tone when the central bank meetings are very much in focus. And sometimes you'll have periods where the central bank simply is not expected to do anything and the market is looking elsewhere. But during this period of time, central bank meetings were very important. So here in January of 2013, you had the euro shooting up on the order of a couple hundred pips in one day, which is a large trading range. And that was an ECB meeting day, and it was based on some things that Mr. Draghi had to say that guided the market and on the ECB's thinking. If I recall correctly, they were expecting him to say something in the direction of easing, and something was not said. And you can see how that central bank meeting set the tone for euro for quite some time. And then he managed to say something at the February meeting that suggested the euro is maybe should weaken, and you can see how that set the tone for quite some time after that meeting. Again, in April, a huge rally day at the April meeting, and so on and so forth. So the actual meeting day itself, sometimes proving critical, and traders need to be aware of the import of these meetings, what the market is anticipating going into these meetings, and the degree of surprise. So, for example, the euro has been quite strong recently because we have the EU economy improving, and yet the ECB has insisted time and time again, we're going to keep a very, very dovish, when I say dovish, that means a very low interest rate, very, not interested in moving to restrict the economy in any way, a very dovish central bank policy. But the market is really strongly beginning to second guess and anticipate that the ECB is going to have to admit that the economy is doing better and may even have to back off of this policy. And the first big indication of this is finally potentially the market thinks coming next Thursday. So you have it's going to be a big day next Thursday based on two things: what the ECB actually says, number one, and number two, has the market over-positioned for that or not positioned sufficiently for whatever outcome is there? So anticipation is also critical, as is positioning. And I'll get to some positioning stuff in a moment too. And especially the Fed's moves from the global financial crisis and onwards have been really massive in moving the market. The dollar was really weak once the Fed really started printing money with its various quantitative easing programs. The first big one, it faded out early in 2010, if I recall correctly, and basically the economy started struggling a little bit, and Mr. Bernanke at a conference in the summer of 2010, August 27th, I think it was, basically hinted at a speech that the second round of quantitative easing, or QE2 as it was known at the time, was on its way. Just mentions it in the speech. No program in place yet, but it gives forward guidance that it's probably on the way. And what happens? You see a massive dollar sell-off. This is Australian dollar versus the US dollar, all the way to what happens here. This is when the program actually began. So by the time the actual money printing and buying of bonds starts taking place, the market has actually completed most of its move. And you can see the dollar actually did okay once the program actually begins. So we have to remember that anticipation is key, and how much is actually priced in before events are actually announced. And then we see that was when new quantitative easing was announced, and that brought QE2, and then that went on for a while, and QE3 came starting in late 2012. And then in May, this is a very famous instance here. This is the US dollar, just so you have an idea. The white is actually the 5-year US interest rate. These other indicators of the dollar versus various emerging market currencies. Now, what happened when the Fed was printing all of this money to deal with the U.S. Subprime and growth crisis in 2009 and 10, etc., was actually because the dollar has a special role as the world's currency, the global reserve currency. It was actually not just doing monetary policy for the U.S. Because dollar is used globally, it was actually stimulating the heck out of the global economy as well. So you had massive booms across emerging markets on easy US dollar-based credit. And here we have Bernanke in May simply mentioning in a speech, again, just a mention in a speech, can move trillions of dollars, that maybe one day the Fed has to think about slowing down this, this money printing. That was all that was said. Fairly innocent, right? Well, the market was not positioned for it. Everybody is having a big party, buying risky assets around the world. And when U.S. interest rates start going up, as they did here, you see the 5-year rate goes from very low to very high, relatively speaking, almost doubling the yield. The excuse me. It actually it put an end. That was actually the end of the emerging market strength, in both in currency and equity and bond terms. Now, it's since come back. It bottomed basically in early 2016, but that was the key event there. It was so-called taper tantrum, the idea that one day the Fed has to slow its asset purchases. And generally, the Fed is the most important bank. In fact, this experience was so traumatic and set off such an alarm across global markets that Bernanke, here you see this is in May 2013. In July, he comes out and says, well, you know what? Maybe someday we do have to do this tapering, this slowing of asset purchases, but it's not going to be anytime soon. Or basically said something to offset. And you see the tremendous effect this had from the time he mentions that as a speech. This is the euro versus the dollar. It goes from 127.50 to as high as about 132 in the space of just two sessions, which is in currency market terms a massive move. And it's very difficult. This so-called forward guidance was easy when they said, well, maybe 2 years from now we'll do something about our policy. But when it gets to the actual point where they need to do something and change the policy, it becomes very difficult to communicate with the market. And that is what the ECB actually faces next week. They are at an inflection point where they need to change their language about their monetary policy, and the market is going crazy thinking about how they're going to change it. And they're very afraid of how the market react to what they say, because they don't want the euro to go too high. It risks dropping inflation too low, et cetera, et cetera. And just to give you a sense, this a difficult chart to understand on the surface of things, but what it's showing is in white, the Fed's balance sheet. So when they're buying assets, this white line is going up. And then we have in green the ECB's assets, or their balance sheet. So we have the Fed doing the quantitative easing 1, quantitative easing 2, and then quantitative easing 3, massive quantitative easing 3, which they stopped by late 2014. It's been flat since then. The ECB did a very different style of program. They did these sort of temporary liquidity facilities to banks to make sure that the banks weren't going to go under across the Eurozone, because the banks were linked to European sovereign debt, and whether it was Italy and Greece and others were going to default. So they lent all kinds of temporary funds. The market believed Draghi in July of 2012 when he said the ECB will do whatever it takes to prevent this from becoming a problem. So the market simply believed him, and belief was enough. And because they believed him so thoroughly, they were happy to buy bonds again. And then all these banks sort of got rid of these temporary liquidity measures, and actually the euro went up. We're seeing the euro versus the dollar in orange here. The euro actually went up because the Fed was still continuing to purchase, which is weak for the dollar, while the ECB's balance sheet actually was reduced because of what the banks were doing. That got to be painful for the Eurozone. Inflation got too low. The euro got too high. Finally, by around mid to late 2014, it was very obvious that the Fed was going to start tightening policy, slowing asset purchase, while it was clear that the Eurozone was in the wrong place and that ECB needed to expand its balance sheet again if it wanted to keep the EU financial system going. So this difference, US tightening, ECB needing to loosen, was the trigger for a massive, one of the sharpest slides in Eurodollar in its history. And it all took place before the actual ECB purchases started. So again, it was almost all of it was in the anticipation phase. So here the ECB is actually at the early 2015 meeting that the ECB started this purchase process, but the entire move was priced in before the fact. And now we have the Eurodollar going up because people are anticipating that the ECB is going to slow or stop purchases at some point. I hope you follow that. It's really important. As well, similar exercise in in the Japanese yen. So first you had the Fed. I may pause periodically to take a sip of water. Just a minute. So basically, you had the Fed's doing its a massive money printing exercise starting in 2009. The Japanese yen got painfully strong and stayed strong, and the economy was in a deflationary funk. Finally, they got on the program as well, starting in late 2012. Actually, the actual policy didn't start until 2013, but the market sniffed it out starting in late 2012 when they saw that an election was coming and they saw what Mr. Abe was promising in terms of policy, and it was clear that there was new blood coming to the Bank of Japan that would involve a massive easing. And again, it was all in the anticipation phase, or most of it was at least. The actual BOJ announcement doesn't come until around here. The rest is anticipation, people seeing what's coming and positioning their portfolios for the run-up. Now here's an entirely different set of observational data you can use to maybe get a position or get a sense of when positioning is getting extreme. The U.S. futures markets, where you can also trade foreign exchange, it's set contract sizes, and it's a little bit different, but of course it all trades off the same data. It gives you a sense every week with this weekly report, so-called COT report, of where the market was positioned, especially speculative traders were positioned relative to commercial traders. And it gives you a sense of how much positioning is out there. And then the assumption is that the global market is also positioned somewhat similarly. And what we have here is you can get a sense of, so this is the yellow is the Canadian dollar versus the US dollar, and the white shows the weekly positioning. So here's the zero level. So when speculators think the Canadian dollar is going up when they're quite long, this is 50,000 contracts. So that's like 5 billion Canadian dollars, which is at the current levels around 4-ish billion US dollars. Back then it was more because they were trading close to parity. And when it's below that level, it means people are short the Canadian dollar versus the US dollar. When does it get interesting? It's not very often that it's especially interesting, but at big, massive inflection points, this can be a very big tip-off indicator that the market is turning or getting overdone. And the example here, well, there's a couple of examples really. I mean, the market was never super enthused about getting short the Canadian dollar versus the US dollar. Positioning never got below about minus 25,000 contracts, as you see here, the white. And we were at these extremes in price, and there was no extreme positioning. A better indicator was here when you had the Canadian dollar way up here at new highs versus the US dollar well over parity, so a spectacular level for the Canadian dollar being worth more than a US dollar, when historically it was more like 1.5 Canadian dollars to US dollars. So new extreme in the price of the Canadian dollar, and yet the positioning is far, far lower. So the enthusiasm for continuing to buy the Canadian dollar is nowhere near where it was at the previous peak. And in fact, that was a critical inflection point. A more famous one, I wrote dollar Canada here, ignore that. This is euro dollar. So you're seeing euro dollar in orange back and forth. And then the white is showing, again, the positioning, the weekly positioning. And here you had, and by the way, this is getting to be massive, historically massive positioning when we're at minus a couple 100,000 contracts. You're talking about 25 billion short position of euros, 25 billion euros short. So, and this is just the U.S. futures market, which is far smaller than the entire over-the-counter foreign exchange market. So here we have the positioning reaching an extreme at this price. Then the price goes to a new low. The euro versus the dollar goes to a new low, and yet the positioning is far altered, and so there's less enthusiasm for continuing to short, even though the price is lower. That also coincided with Draghi coming out and saying, I will do whatever it takes to save the euro, and the market believed him, and then the euro was off to the races higher. A smaller example, actually still in the same chart, you had a new high in the euro versus the dollar relative to the recent one, and the positioning was marginally lower. It's just less extreme than this example back here. And there have been more recent examples as well. So there are times and phases in the market history when you do have foreign exchange behaving like a passive asset class. And that is in times generally when the global growth mood is, or tendency is very positive, and when markets are happy to take risks, and when the dollar tends to be relatively weak. The most famous one in recent history was the Japanese yen carry trade, where what the chart is showing here is a series of higher yielding currencies, so currencies with higher interest rates. Not all of them emerging markets, but the Australian dollar and the New Zealand dollar were the highest yielding of the so-called developed market or G10 currencies. And then a number of emerging market currencies, Polish zloty, Turkish lira, Mexican peso, Indonesian rupiah, Brazilian real, etc. And going along those currencies versus the Japanese yen. You can see here, just in currency terms, with 1 times leverage, so buy 1 unit of these currencies relative to 1 unit of money in your bank account. And if you include the interest rate differentials, which is important because these yield a lot more, you're looking at 100% return in just a few years. And of course, with currencies, you have leverage available. So somebody doing this kind of trade with several times leverage is, looking at this, staggering returns. It looked like a great trade. Japanese domestic investors were massively into this trade as well. Unfortunately, these things overextend in the global financial crisis. It collapsed in a matter of a couple of weeks. So we have to be careful whether we're in a risk-happy phase or a risk-averse phase. Here we saw it repeat itself a bit when Bank of Japan started printing money. And actually during this whole 2009, 10, 11 phase, the dollar was the more favorite currency to be short because of the Fed's money printing. So sometimes these carry trades come into being and last for a couple of years, and you do have a passive strategy that is, sort of a steady return type of strategy. And one point I wanted to make was, especially with emerging markets, one of the unique things about currencies is, in that case, is the currency itself is often the chief explainer of your returns, of your total returns when you're investing in emerging markets, because the flow, these are smaller markets, so the flows in and out of the country immediately get push the currency up and down, and so some people can would prefer to avoid trying to select bonds and select equities and simply invest in the currency itself. The other novel thing about foreign exchange is that it's hard to short an emerging market bond. It's hard to short an emerging market stock. But if things are going the opposite way and these currencies are collapsing or going down, foreign exchange is a way to trade the downside as well as the upside, which is very hard to do, again, in bonds and equities in these countries, or can be, depending on the country. Excuse me. And how does this and this whole idea of carry? When I say carry, I mean I'm talking about an interest rate differential, and it's not just about carry as in the carry trade, but also carry as in you have to consider what's happening, where interest rate expectations are over time. So, for example, the U.S. interest rate is much higher than the European interest rate, which is actually negative. So going forward, the dollar is going to be worth less because you get paid in dollars. So if I want to buy where the euro dollar is in 6 months from now, I'm showing here this is the spot rate. This is where spot meaning is you're never trading what the currency exchange rate is today, but in 2 days' time, that's what the spot rate is. It's 111.43, and I took these screen grabs at the same time. 6 months forward, it's actually 112.48. And the reason for that difference is the expected change, or the difference in the interest rates over time. This has to be the case, otherwise there would be free money out there if you could trade at the same month, same rates 6 months forward, because of the way interest rates differentials work. So you need to be aware of the carry if you're holding a position for a long period of time, depending on if you're selling or buying the higher yielding currency. In other words, if I do buy euro dollar, if the rate doesn't change over the next 6 months, it'll end up at this level over that time to compensate me for holding the weaker yielding currency versus the stronger one. I explained that poorly, but the key thing to note is the difference in interest rates is reflected in the rate over time, and that's why you have a different rate for 6 months from now relative to the current rate. And dollar, especially something like the dollar versus the Russian ruble, the carry is especially large when you have a policy rate, a central bank policy rate in Russia that's I think currently it's 9.25%, and it was 10%. It was even 17% during the crisis linked to the oil collapse in oil and Ukraine confrontation in Russia as well. So these are a significant part of your return. What you're seeing here is what it looked like in spot terms, what the exchange rate did. But if you add in the interest rate differential, you got compensated a lot from the lows here by being paid in ruble interest rates if you were holding ruble assets. So somebody holding for example, Russian ruble bond over the last 18 months has made out like a bandit, because not only has the Russian ruble appreciated significantly on the order of 25%, but on top of that, you've received 10% or more of carry. Now, it's very difficult. A note of caution here: we all like to think about what is China's policy going to do. They're weakening their currency. Is there a way to trade that? Yes, there is a way to trade that. And yes, it's extremely risky. And the reason it's extremely risky is that the Chinese regime is constantly trying to punish people for speculating in their currency, and doesn't want the speculative positioning to get excessive, and consistently goes in and makes it very uncomfortable to sell the Chinese yuan, at least in its offshore form, which is the only way you and I can trade the Chinese currency, the offshore Chinese yuan. So over time, it's expected to fall. It's expected to weaken. That's why we're seeing the dollar rising versus that's for 6 months relative to the current levels. And it's not just the interest rate differential, but also there's a bit of a premium because of what's expected to happen. But when you try to hold this position, as people have discovered in recent days, they do things like crank up the Chinese regulators will crank up the overnight interest rates to something like, I think they've been as high as 100%. That's annualized, so of course that's only 0.5% maybe-ish. But that's 0.5% for just holding a position overnight, and it's not fun to do that. So we have to be really careful about how how these things affect the market and whether it's worth the risk to trade something like at least the spot for dollar versus CNH. And that's why the Chinese currency relative to the dollar, the orange here is the dollar versus CNH, has fallen off a cliff recently. The CNH has gone up because the white is showing how much how uncomfortable it's making the Chinese authorities are making it to hold these positions overnight, the so-called forward points. Now that's a bit about the fundamentals of trading, some aspects of where you can look. I actually got a couple more in a moment, but I'm also going to cover a few things that are happening in the market here, and big themes the market is looking at right now. One of those is tightening of Chinese credit, and that's evident in the Chinese yield curve going negative at times. If we look at the 3-year versus the 10-year, you can see that's highly unusual relative to past history. It's a classic recessionary indicator, or at least a classic indicator showing risk of recession, something to pay attention to. And it makes sense because the Chinese credit has been tightened dramatically from very loose levels last year. China is concerned about too much debt in its system and is actually really taking it seriously this time, it looks like. And that's a threat to global growth. So this is a very important thing to follow. We're actually going to be talking about this a lot in our Q3 outlook. And I see I'm running out of time a little bit, so I might rush through these last few charts just a bit. What is the market looking at in terms of euro-dollar? I talked about that a little bit, but here's some more fine-grained charts. So we have the euro-dollar rate in white, bottoming out below, I believe was below, a little bit below 104, and you can see some of these indicators very tightly correlated, like the 10-year interest rate spread, which is shown in orange in particular. That one has actually failed to improve a lot with some of the most recent sharp appreciation. One of the reasons for that is an enthusiasm for buying European assets, which is a bit hard to, which I haven't shown in this chart, but could probably be shown with some of the relative performance metrics on European equities, especially key sectors versus US equities. But another indicator has been, if you think about the French election and the sort of the sigh of relief that Marine Le Pen was not elected, how does that show up? That shows up in the market being happier to not worry about, the likes of Italy, France, and other countries defaulting, and that's shown in their bond yields. The tightening of the bond yield spread between something like Germany and Italy, which is shown here in blue. So as people get worried, as they were at the maximum here in April, they're pricing Italian bonds at 210 basis points, so 2.1% higher than German bonds of the same 10-year same 10-year variety. Since then, it's come into, it's actually not what it is right now. This was taken a couple weeks ago, but it's come in a lot, and well under 2%. And that has helped this lack of worry about EU existential threats, etc., has helped to support the euro as well. And then on the US dollar side, again, you're trading a relationship. You're not just trading the euro, you're also trading the dollar. When you're trading euro dollar, we've seen a cooling of expectations at the Fed, which I've shown with the green line here, although that's very closely linked as well to the interest rate spread. And this is just showing only the spread of German bonds to key EU peripheral countries to see how that develops. And you can see especially Greece, which is on its own axis here, has really come under, has really found support. Greek yields falling considerably. Consider here they were at in 2015 when we had all the worries about a default. They were at 14% above German yields. Now they're only 5% or so, 5.5% above German yields, and they've probably developed further since this snapshot was taken. Portuguese yields have come in very considerably from 3.8% to 2.7%, et cetera, et cetera. The French worries were very minor. And then after the election, they've come in as well. So the story now is that we don't have to worry about the EU peripheral situation. I think we do longer term, but for now, it's off the market's sort of worry radar. Has come back in a little bit because it looks like Italy may be headed to the election, to the polls early in the fall, so we'll have to track that. Excuse me. Now, another sort of very broad market indicator that gives you a sense of the energy in the market, and it often is similar to the energy in global equity markets. If you're used to trading equities in the U.S., you probably know that the VIX index that measures volatility has recently hit 10 and even below 10 on a couple of occasions recently, suggesting a lot of complacency, very little fear, and you see this fear gauge in implied volatility in options markets for foreign exchange as well. So this is the 1-year volatility, implied volatility for Eurodollar in orange, dollar in blue, and Australian dollar versus US dollar in gray. Roughly tend to follow one another, and this is a special issue related to individual currencies. And the bottoms were in 2007, of course, just before the global financial crisis, and in 2014, just before that big divergence trade between U.S. and ECB policy. It's getting awfully quiet again, and I suspect we're leading into a new, more volatile phase soon, but this could just continue to dip into the summer if nothing happens. But I think we're getting into some longer-term opportunities as well. I think the market's going to heat up. And another thing besides the options volatility itself, so this is the how the market is pricing the potential for 1-year volatility. So 7.8 is 7.8% implied volatility for the coming year. This the skew is measured in how much more it costs for puts versus calls. So here we have the skew for I don't have it on here. Yes, I do. This is the skew of dollar versus yen options for 3-month options with the 25 delta shown in white, and then the actual dollar yen rate shown in orange. Briefly, this is pretty technical stuff, but it can be a very interesting indicator because sometimes the options market turns well before the actual spot market or foreign exchange market itself turns. So here you see, for example, at the absolute bottoms, here's dollar yen at a very low level, well below 80, and people are wondering, gosh, is it going to continue to go down forever? Well, the people are not worried about downside because the options markets, traditionally dollar yen options cost more for downside than they do for upside, but here they are. There's no premium on buying downside options, and in fact, look, we see a pretty sizable rally coming in shortly after that. And then we're at the record highs, the record all-time highs in this skew come well before. So there are a ton of people moving into getting long of dollar yen via options through here to a record degree relative to the recent history. A lot of that before the actual move in dollar yen unfolds. Another example, you're seeing here you have you've seen a big correction in dollar yen. So we're down here trading around 10. I think we're close to 100 at that point in time. Sorry, keep clicking on the mouse. But the fear levels had evened off, and we'd actually started pushing back the other way in terms of the option skew. So it didn't look like people were really worried about downside. In fact, the support held quite well, and it rallied considerably. Here, somewhat similar. It was going to continue to go higher while the skew had rolled over a bit before the actual price had. Again, it's one of these things that's at big market turning points. It's not a day-to-day thing, but it can be a powerful indicator. Actually, the first one I neglected to show is the big panic lows immediately after the global financial crisis. Here we were close to or at the lows, and the options market really pulled off of the fear levels shown down here with massive put skew here, a skew in favor of puts. I won't cover that one. Fed expectations. One of the reasons the dollar is languishing is that everyone's frustrated with Trump unable to do anything to help stimulate the U.S. economy. The Fed is going to hike rates once and maybe a second time, but the market's just not very excited about it, and so the dollar is kind of languishing. It doesn't look like it's going to go anywhere. That's shown here in the U.S. 2-year rate, not really doing anything over the last, call it 6 months since the election, which really supported the dollar with a massive anticipation of Fed rate hikes. Now, this is just one to tuck into the back of your mind. Again, not a day-to-day indicator, but something I suspect could be at the center if we do have a new sort of global upset or systemic kind of situation in global markets. I think it could be linked to the US dollar, and especially its role outside of the US with these so-called offshore dollars. So dollars aren't created just by US banks or by the Fed. They can also be borrowed into existence anywhere in the world where a bank is willing to take the risk that somebody is going to pay them back in dollars. So you can have a Brazilian bank creating dollars out of thin air by lending them into existence. And that's what you're seeing here. Dollar funding, non-US banks, you can see how large it is here. And then, of course, international companies can also they can issue bonds in US dollars as well. And this is trillions of dollars here. So this is an $8-9 trillion situation or setup, which is risky if the Fed is continuing to hike rates. And there's $9 trillion of funding out there, or of course the blue is in the US, but the rest is outside. If there's a shortage of dollars, that could suddenly become a really critical issue, especially for emerging markets. And this chart here on the right shows how much a 1 percentage point change in interest rates actually affects the value of bonds, and it's a lot. We're talking about enormous effects of the Fed. And does the Fed really control these offshore dollars? Would it be willing to do anything about them if there is a crisis? It could be at the center of the next big market event, if you will. I'm not trying to predict a catastrophe, but it's just one of these things that's out there as an issue. And this dollar issue as the global reserve currency is just it's not sustainable in the long term, and something needs to replace the dollar, but nobody knows what that is or has a good idea just yet. So be aware of that one. Also be aware of Canadian banks, which are falling a lot. Why? Because all these low interest rates, you guys know this in Denmark, and you know this in Norway. These very, very low rates is making asset prices very, very expensive because it's easy to make the payments on lots of millions of krona of a Norwegian or a Danish variety when the interest rates are nil. So this is an issue that's it seems to be hitting Canada first. They're worried in Australia as well. All of the smaller developed market economies have this problem. So pay attention to this. It's coming to us as interest rates turn, if not before, whenever the next recession is. But it seems to be hitting Canada first. There was a subprime lender there that got into trouble already. And it's one of these things where it's simply confidence itself and key borrowers, there's housing activity simply slowing, and it create its own issues. But it could also come to Australia soon, New Zealand, Sweden, Norway, all of these countries. And leverage is everywhere a problem, also in China. That's why China is cracking down. Here we have debt to GDP ratios, private debt. This is Steve Keen. You can see the link here that has created these charts. It's been rising as a percentage of GDP, and credit growth is 4 times of actual GDP growth. That's unsustainable. So let's take Australia as the example. Blue, you have Australian credit growth in 2015 at, let's call it 15%, and what's the GDP growth? 3-4%. So you're talking about 4 or 5 times credit growth relative to actual growth. Unsustainable, and this credit crunch is coming to these countries at some point. And here you see, this is a chart I made up showing the real interest rate spread. So it includes inflation. So not just how much you're getting from the interest rate itself, but the interest rate plus inflation. And I mentioned that Norwegian real rates were very, very low. And that is one of the reasons why you have euro versus NOK up, back up near 9.5 again, because it was no fun to own the Norwegian krona when interest rates are negative. So it's no fun to have 0.5% deposit rates and you have 3% inflation. That was a killer for the Norwegian krona. So current market themes and questions from here. For the U.S., we have a fading economy, potentially. Some of the numbers are coming off. Are we at an inflection point? Are we risking a recession? The Trump hopes around the so-called Trump trade, new especially tax policy. Is it ever going to come on board? There's still some upside potential there from that if he is able to pull a rabbit out of his hat, which would get the Fed hiking rates again and more quickly. The dollar is relatively expensive. And then as a side note that I mentioned before, there's this odd thing about the dollar with its role as the global reserve currency. Euro economy is doing very well, especially by European standards. A lot of that linked to ECB credit easing, or easing because of ECB's asset purchases. The existential risks are fading for now, and people are anticipating the ECB has to change its policy. So there's a big inflection point possibly coming. For Japan, it's about their very easy monetary policy, and whenever interest rates go up, the Japanese yen goes down because they've frozen their bond yields from 0 to 10 years. But the currency is already very cheap. Same with the UK, with the sterling, and so on down the line. Actually, I think I'd like to get to your questions. We're coming up on an hour here, and especially if you have any questions, I'm not going to have time to run through the charts as much as I wanted to, but if we have any questions on charts or how I look at the market, I'd like to take it from a question rather than me simply launching into that. Very briefly, I think what's the big focus, I think, for currencies from here is that at some point we do run into the next recession or whatever, whether it's the US that it comes to first. Actually, it's probably likely China is tightening. China's going to slow first, and then it's going to hit the US next because the US is the furthest along in terms of its economic cycle. And what does policy look like when you hit a recession, when your interest rates are so close to zero? We're going to see central banks not really having the importance that they had before because monetary policy acting by itself stops working when you're at zero interest rates. All that this money printing and monetary policy is done in its later phases after saving the economy from a liquidity crisis is to pump up asset prices. It doesn't make the economy grow, and it certainly doesn't make it grow sustainably. So what we're going to see is a term you'll see a lot more of. We've seen a lot of it, but you'll see more helicopter money, fiscal stimulus. What will that do? It'll stimulate economic growth. It will also stimulate the inflation that governments so desperately want and need to devalue the real level of all that debt. And growth, it doesn't have to go down, but growth could be lower than inflation. And that means that the debt, in terms of its relative size relative to the economy, shrinks. But so do our savings. The debt shrinks, but so do the savings. That's what the future holds. Key event risks coming up next Thursday. Apologies once again. UK election, critical for the pound. ECB meeting, critical for euro. We have a report from the US Commerce Department on the U.S. trade deficit, or what's causing that, and there could be indications there on currency manipulation from China, Japan, and others. It could be a market-changing event. This one here, it could be a very big one. It could be nothing, but it could mean something very significant is announced by the U.S. Based on that report. So keep an eye on that one, as well as the mid-June FOMC meeting. So I think with that, I'd like to get to the questions. So I feel like there's a bit of interactivity going on before our session winds down in 26 minutes time.
Yeah, thank you, John. Actually, there haven't been any questions yet. So okay. If you want to look at some charts, you have the time to do so.
Okay, and if anything pops up, do please pass on a question or two, and we'll have a look. So I still have the screen, I assume, and I will pop over to the charts here. How do I look at charts? Let's see here. There we go. Some of the indicators I use for tactical trend indications. You see the pink line here. It's a 10-day emerging exponential moving average. I think is a good when markets are trending in a sort of a tighter, shorter term trend. it's a decent indicator for where the very short-term trend is. And then for the slightly longer-term trend, 21-day simple moving average. And then, of course, when those cross each other, that could be interesting. 100-day and 200-day moving averages. You can see the influence of the 200-day moving average here. It's actually a pretty interesting confluence of events. You had the major low before, this is euro versus the dollar, by the way, before the US election, when it looked like Clinton was going to win at around 108.50. And then you saw the election itself, a crazy freak out day, and that set the bar there. And then that was retested in early December and retested a couple more times. And then around the French election, that's when it finally broke this level. And actually provided the support, more or less, post the French election result here, and we've rallied since then. So a pivotal level there, 108.50. I think the key level or support for this trend is around 110. Round levels are quite important for euro-dollar. Sometimes you'll find that these levels are sticky. Going back in time, you can see how this 110 level proved kind of pivotal at various points. Here, this was after Brexit. Couldn't quite take out the 110 level. And then the 115 level is at this level. Sorry. That provided the cap, except for a couple of intraday, maybe 48-hour pushes above that level. Provided the cap all the way through 2015 and 2016. So 115 to the upside looks pretty important if this rally is going to continue. Fibonacci's are Fibonacci sequences. If you're familiar with those, Fibonacci levels are very important in foreign exchange, especially for the liquid pairs. How do you use them? I like to use 618 Fibos at turning points. And what I mean by that is here we have a big down sequence, euro-dollar going lower and lower and lower. It collapses to the new lows here, makes a significant rally here that sort of wipes out the last sell-off wave. So to me, that's starting to neutralize the chart. So the reason you look for a turnaround Fibonacci is what I call it, 61.8, is because maybe the chart is turning around. And indeed, that 618 level, and actually the round level of 105, again, I talked about round levels, is that area was the support for euro-dollar as it turned around at that point in time. You can also zoom in a bit and see a similar setup here. So here we had the new lows, more locally speaking. First rally attempt and then the second one. So we're starting to show that we're not wanting to go lower here at this point. And this 618 level proved fairly important once again, near the 104.50 area. And you can find these all over the place. Nothing's going to support at every point in time. Now, a continuation Fibonacci could be the 382. That's when you're looking for a trend to continue rather than looking for a new trend to be to get underway. And here we have, for example, this move after the French election. It was the 382 was where this support came in for the continuation move higher. And that happened once again. Here we have another very strong trending move. Again, we're not looking for a turnaround. We're just looking for support to sort of say, yes, this trend is still valid. And that support came in just a couple of pips ahead of the 0.382 or 38.2% Fibonacci of that move. Now, in terms of market potential or volatility potential in the market, I think it's somewhat low right now. If you look at a average trading range to get a sense of where we are, using a 50-day exponential moving average, you can see we're at the very lower end of daily moves. So it's a bit hard to extract opportunities from this market in terms of actual pips. It was worse in 2014, but it's pretty bad relative to the last couple of years of history. So we like to see a bit more volatility for opportunity. And you can see it when it does go to these very, very remarkably low levels. When it finally digs itself out of this volatility, low volatility, sometimes the volatility becomes quite remarkable. And that's where we saw the big, steep sell-off in euro-dollar. Structurally speaking, it's the people who are looking for a lower euro don't have much to argue for because the big attempts to break this low for the cycle. It's a bit hoppy because I've scrunched the chart so much. this was rejected, and we've come up so much that we're still back in the range here. So we're in a bit of limbo here on euro-dollar in a structural sense. It needs a lot more to start to argue for much higher levels, for a breakout higher, but certainly nothing pointing downward at this point in time. And take something else like the Australian dollar. It's showing signs of getting back into bearish mode. We see this 75 area, and again, round numbers can be quite often be very important. The 75 level has been pivotal at a number of times for the last 6-8 months. It had some false breaks lower, finally broke lower recently. What drives the Australian dollar? Of course, interest rate policy always does, but also China, and people were really starting to pick up their worries on the Chinese economy. And Australia is a satellite economy to China, especially basically digging up commodities and sending them to China is a huge chunk of the Australian economy. And the biggest of those commodities is iron ore, and iron ore prices have been collapsing recently. So nobody's expecting the Australian Central Bank, the Reserve Bank, to do anything with rates anytime soon, and their main export price is collapsing, sort of like iron ore is to Australia, somewhat, although less intensively, somewhat like oil is to Norway. So some big risks there, and it's pretty remarkable that we've had this decline in the Australian dollar versus the US dollar, given that the dollar has not really been performing that well. So the bigger trade, and again, this is kind of cool with currencies because you can match, mix and match what you want to trade versus what. You've had a dramatic turnaround sentiment in the euro, so the trend in the euro versus the Aussie has been very, very significant with a 10% rally. Okay. Other indicators, if you're not familiar with them, the Japanese market, they're quite fond of this so-called Ichimoku set of indicators, and these can be very interesting at times, especially for the Japanese yen currency pairs. So you can see here locally, there's a lot of interest in this so-called cloud level, where we're sort of stuck in no man's land here. Again, we saw, look at Fibos, we saw the 618 area is very important for whether we're going to continue lower in dollar yen or we're just going to find support and rally back higher. As well, tactically, I think there's a lot of focus on the Ichimoku cloud levels. And tomorrow, I think, is going to provide our directional indicator for dollar yen because of the U.S. economic data, which tends to move U.S. interest rates. And Japanese yen is very sensitive to interest rate moves because the Bank of Japan's monetary policy has frozen yields from 0 to 10 years. So all the adjustment is made by the currency market rather than the bond market. So either we're going to break down through this 110 level, the cloud, and the 200-day moving average, or we're going to survive, and that could set us back focusing higher once again for dollar yen. Sterling versus dollar, sometimes called cable, is quite interesting as well, but I think it's in a nervous holding pattern until the election. Suddenly the Labour is looking like it has a chance to make life difficult for the Tories, so the market is uncertain what to do about this. This 127.75 to 128 area is massively important. That was the big low established after the Brexit vote. You see the huge collapse in sterling versus the dollar on the Brexit vote in June of last year. That level was then broken, provided the resistance, and now has been broken again, and now it's providing support. So we're looking very much at this, whether 130 can be taken out post the election or whether 127.75-ish falls on the other side of the election. I have my concerns about sterling, but if the dollar is also weak, then it's maybe a bit tough there. More interesting could be, again, depending on sentiment, the euro versus the sterling, although that one's getting towards the top of its range. So it's going to be, and the election doesn't really solve anything in terms of the actual Brexit negotiations. So I'm not sure we get really any euro versus sterling drama until we start to see how the EU side starts to treat Britain and how much it's going to try to take out of or sort of punish Britain for exiting the EU. And you can see the volatility has really been coming down. This is our trading range indicator has been really coming down for euro versus sterling, as well as people aren't sure whether what's going to happen next in terms of the negotiations. And likely the EU starts with a very tough stance and then moves to an easier one. Yeah, were there any other specific currency pairs that people are interested in, or?
No, it doesn't seem to be that so.
Okay.
But we have some other questions now.
Okay, super.
Yeah. One guy is asking where you find all the information you are showing, referring to interest rate comparison between countries and bonds, for example.
Yeah, that's not an easy one to answer. I mean, there are data services that a lot of these charts I pulled off of Bloomberg, which is a very expensive. It's what all the institutional and market participants use, and it's incredibly an incredible piece of software with a tremendous database. A lot of this data though is available, and I'm sure a lot of it can be put together via publicly available sources. But you're right; it's not trivial to find a data provider. But I presented all this just to show you some of the complexities as well as the drivers. So if you really want to get into this, then you're going to need to find at least somebody that's providing this kind of data to if you want to build some kind of models or track these kinds of things.
Yeah.
But there are less expensive options than Bloomberg.
Another one asks if you can recommend a book on forex theory.
That's a really good question. I don't think I've actually read any books on forex theory. I think the best thing to do is hopefully I've provided some education and touched on some themes today. But it's to sort of, just like any market really, is to follow the market day to day and see what the news is, how the market reacts, get a sense of what the themes are, and what's moving what. I think foreign exchange is very unique among asset classes because it's really macro. It's really looking at everything going on, where the money is going from and to in the world, and this is pretty exciting because this is because you're looking at the big picture all the time. Of course, you need to know the policy details. You need to know where the market focus is. Does the market care about the next CPI release from Norway or not, etc. But that's my unhelpful answer to that question, I'm afraid. But plenty of books on trading and trading related topics. But I think for forex, especially because again the nature of what people are focusing on changes so rapidly from month to month that it's difficult to point to anything, any single book.
Yeah. Another question. In which time frame do you mostly trade? Hours, daily? Yeah.
Yeah, it depends on the currency pair. I think one of the more tradable higher frequency pairs is the euro dollar. I mean, the euro dollar is a massively liquid currency, but you need to have a little bit going on when the trading ranges get too tight, and they're kind of getting that way at times recently. It becomes less tradable, but anything's tradable on a single day basis. But I think I tend to look at daily charts and look for a trading opportunity that's at least a couple or 3 days, and then occasionally something is going to go for a couple of weeks or more. And looking at the euro dollar chart here, you can see that a lot of these swings in the market happen sort of within that time frame. So a good pull or swing is maybe 10 days. You can see here if people are still able to see my screen. But when the market's really trending and something really strong is going on, you just have to sort of be in the market and hang on. And that was the case certainly during late 2014 for the euro versus the dollar. It was just one long and brutal trend. So it's constantly changing, as are all markets. But I think foreign exchange in particular, you've got to have something that's going to stimulate a big trend to become a trend trader, versus a swing trader versus a day trader. So you're going to have to be flexible in your approach.
Yeah, another question. Do you have any ground rules you use when you trade Forex?
Ground rules? I'm not sure. I think one of the ground rules is trade what's moving. And trade the strongest and the weakest currencies. You know, something that people are there's stimulating a lot of movement. You know, sometimes I think I have a tendency sometimes to think this way. I'm a little bit too dollar fixated, and sometimes the dollar is not really the mover. It could be the yen and then the Australian dollar that are the big movers. And I should maybe be trading Australian dollar versus the Japanese yen, or as I showed earlier, the euro versus the Australian dollar, because people are excited about the euro. And new themes coming into the euro, but they're, you know, so the euro is going higher. At the same time, the fundamentals are really eroding quite noticeably for the Australian dollar. So trade what's moving, trade what the market is focusing on, trade something that has hotter, newer information that's driving it, especially something that's a bigger theme or trend in the market.
Okay. What about volume indicators? Do you use that when you trade? I'm
not aware that any volume data is available because it's an over-the-counter market. You can get, as I showed, positioning data. You can get some positioning data from the foreign exchange, the futures exchanges in the U.S. That's reported on a Friday, showing what the positioning was as of Tuesday. You can get daily volume information from futures, but that's not the whole market. It's only a corner of the market. And because it's an over-the-counter market, it means there's a million banks out there that are participating in this market, and they're not aggregating their volume information. So unfortunately, you don't have a sense of volume from the whole market, although you can get it for, and I would say you should limit yourself to the most liquid U.S. Futures contracts if you're interested in volume.
Yeah. Okay. Last question. Do you wait to take positions until after an event, or do you guess the outcome of the event and get into position?
Both,
before?
And that's a very good question, because sometimes especially when it's clear that an economic data release is very, very important. You want to position yourself before the event because you think the market's going to move a lot. But then again, if you're wrong, then you get stopped out immediately. So, but there's one of the interesting things and cool things about the foreign exchange market is the flexibility in the options market. So if you really think there's a big opportunity, but also a big risk, you can take an option for as little as a day or two. And, unfortunately, of course, those options can get very expensive if the market knows it's a really big event risk. But there's still opportunity in limiting the risk by taking position ahead of the events. I generally prefer to wait until after the move has started. So wait for the break before getting in, wait for the event before getting in, etc. That's my preference, but sometimes you think the opportunity is too big, or you're looking far ahead and you say, well, I really want to be involved at this price, which I think is wrong, but I think I'll take an option instead of, if I don't have a technical setup that's appropriate.
Okay.
I hope that answers.
Yeah, I think so. Thank you, John, for a really interesting webinar.
Yeah, I hope so. Thanks.
Yeah, I hope everyone have learned something and gotten some inputs for their own trading and strategies. Yeah, so I think that's it for today.
Great.
Yeah, thank you, John.
My pleasure, and good luck to everyone out there. And I hope you got something out of the presentation, and all the best of luck in your future endeavors and trading and otherwise.